What's up, world? Jeremy Baxter here. It is September 26th, 2022, and it's been an exciting Monday already. The markets just closed here a little bit ago, and I'm going to go over a couple of things because I've had multiple conversations this morning with people that own homes and that want to do what's right with their equity and how to protect themselves in this market. And then also I have people that are buying homes right now and they're like, what are we going to do in this interest rate environment? What's happening to the central banking system? What's happening to housing? And we're going to cover how to measure what the correction looks like in your area. So I will go over that. First, let's go to the bond chart. So this closed out a little bit at 2 o'clock today. We closed down 155 basis points, and rates start with a 7 for the majority of people, high sixes for those that have exceptional variables in their scenario. So yeah, starts with a 7. Affordability is the problem right now, and a lot of it has to do with the Fed funds rate. And last Wednesday, when Chair Powell spoke, he had some dark words to say. So basically, what he said was that we're going to raise the Fed funds rate another 75 basis points, 0.75%. And they also stated, it pointed out that they most likely overcorrected on these jumps here. They're going to have to pivot back before things come back into line. The other thing too is that they really don't have a handle on inflation, and that kind of spooked the investors in the markets. So I want to go back to June. This was June 14th and 15th, where the Fed said, hey, we're going to boost this up 75 basis points. The market liked it because they're like, great, they're really doing something to tackle inflation. And the bond reacted favorably. Interest rates went down a little bit. They were great. And then we also had the same thing happen in July when they boosted it. And then Wednesday, it was a little bit of a different tone, a little bit different story that they were saying. So, but again, it points to that they don't have a hold on inflation. They probably overcorrected. The markets are seeing this today. We had some financial news, and actually, it goes back. Part of it goes back to last Thursday when Japan announced that, hey, they're going to start boosting their Fed funds rate. A lot of people had their eye on China over the last few months, or excuse me, Japan over the last few months to watch for this. It's starting to do that. The yen tanked, and now it basically set off a global treasury dump for a lot of other banks. And so, BOE, Bank of Europe, England, also said, hey, we're going to reassess our assets. We're going to reprice our assets due to the market and what's happening. And the British pound tanked today too. It was a 24-year low for the yen. And so we're seeing a lot going on in the markets right now. And this is all kind of tied in with that. So the other thing I want to talk about is we're seeing a lot of chatter about, a correction, right? And so I want to talk a little bit about that. So in light of what we just talked about in the market, a lot of homeowners over the last 2 years are equity rich. They had insane gains in equity, and they've got a lot of equity sitting in their home that's tappable right now. But what do you do with that, right? And so if you're concerned about a market crash or a correction of 10%, 15, 20, 30, 40 in some markets, the best thing to do is start looking at your equity. Speak with me, speak with an advisor to where we can see what your assets look like, and you want to capture those gains. So we want to see all your equity and you want to capture those gains. What that means is you can open up a home equity line of credit to access that money. You can do a refinance, a cash out refinance. Some of you will be trading a interest rate that starts with a 2 or a 3 for something that starts with a 6 or 7. And it does make sense in some cases where you're paying off debt and minimizing your monthly overall cost, taking enough money out to cushion you through the next 12 to 15 months, and then also some to invest. And so one of the strategies that I'm discussing with my clients that have homes and they want to use their equity is let's take that equity out. If you're concerned about that, a drop, let's say 17%, and you can take a good chunk of money, put it into another appreciating asset that has, it's yielding you a guaranteed rate of return. You can meet with a financial advisor and put it there. And that way, if it does reduce, you've got some to offset some of that loss. Okay, so you're basically breaking even on there, and we can help you with that strategy. So the other thing I want to look at is the reductions that we're seeing in the housing market and the correction and what that looks like. And so one way that we measure that, it's called the PE. So it's price to earnings. So it's the median home price compared to the annual rates, and you divide that, okay, and that gives you your percentage. And you want to take that percentage and see where it compares to the long running percentage ratio of that statistic. And so I'm going to go into that real quick because it's pretty interesting to kind of give you a heads up of where we're heading and how you can protect yourself and be aware so that you're not caught off guard. One of the ways here, looks like I closed this out, and don't laugh at my desktop. So here's one right here. So let's bring this up. I'm going to bring this one up, and I'm going to bring this and one more. So right now, I'm in Washington State, Seattle Metro, and so this is for Pierce County here. And basically, what we look at is the report card. So right now, the median home price is $615,970, 20% 5-year appreciation. So cool, we got some good things happening there. And then what we do is we divide that number with the median household income, which is 90,712 median household here. And so when we divide that, we come up with a figure that's 6.75%. All right. And now when we hold that to light of the long term, the long running in Seattle, it's 5.6 years of median household income to buy median home. So it's 5.6%. That's the base level, and we're at 6.7. So one of the things that we can do is look at that and go, okay, so we're going to need just a little over 17% correction to bring this housing market into unity or into harmony with itself. Again, it is an affordability issue. And so a 17% reduction on your gains right now, it can be significant. So if you say you have $200,000 in equity and you get 20% reduction on that, that's $40,000 that's just disappeared into thick, foggy air where I'm at, or thin air if you live in Denver. And so we want to help you secure that and keep that safe. And so that's why I'm making this video, just to kind of give you an idea of what we're seeing, what the data is showing, so that you can be on the front end of that and kind of decide what you're doing and what you want to do with your money. I'm here to help you with those decisions. So real quick, I know it doesn't look great, but there's a lot to be, there's a lot coming. There's a lot to be excited about. So part of that is educating you guys through this on how to navigate it. And then on the other side, when the recession hits, we will see a reduction in home prices. We'll see a reduction in interest rates as well. So if you're priced out of the game right now, there are things you can do to prep for that. And that's what I'm helping a lot of people with right now. And it's exciting when you take a bird's eye view and you look at it and you have a plan in place and you follow that plan. And then when you're able to pull that trigger, bam. So there is some good news coming right now. It's just, it's ugly, but we're able to navigate it, and you can still build wealth in this market. So anyway, just real quick, I appreciate you guys listening to this. Like, subscribe, comment, let me know what questions you have, and let's have some dialogue around this. It's important. Talk to you soon. Bye.